Hi, thank you. Hope you enjoyed lunch. I did. Hopefully you enjoyed it. Right, so we're into the afternoon session. Needs no introduction really, but I will. This is Paul from Merce, who's going to take you through the valuation along with his colleague Jonathan. Over to you, Paul.
Thank you, Gary. Good afternoon, everyone. It's good to see everybody again. I sort of remember it last year, like it was yesterday, but I do feel after this year of valuations, definitely about 10 years old and not just one, with everything else that's going on. Just to give you an overview of what we're actually going to talk about, we're going to go through the valuation, which is the key part of it, but we're also going to cover some very topical issues which will affect you as employers. I'm going to kick it off, talk about some of the high-level strategic considerations and decisions we've made in terms of building up the valuation funding plan. Jonathan's going to come and talk to you about some of the outputs, some of the information that is going to be pertinent to you as individual employers. At that point, we will pause for questions before we go on to the next section, so you can all scribble down your sort of key points, because I think there are two distinct sections, and I think that will work better. So without further ado, I shall start it off. If I can get the clicker to work. There you go. It's always worthwhile sort of going back to basics here in terms of what we're actually trying to achieve. Essentially is about working out the contribution rates for you as employers from 1st of April next year. So it's actually a critical thing from a budgeting perspective. And if you think about what we're actually trying to do with the pension fund and what it's about, it's essentially there to pay benefits. Unfortunately, you have to pay for those benefits, you as employers, the employees, and that's what we're trying to do here, is to get the balance. How much money do we need now to pay the benefits for potentially in the next 100 years? That's the time frame we're talking about here. So really what we have to do as part of the valuation is look about what we've got today. So that's around, we call the past service, the solvency. Have we got enough assets to actually pay the benefits that are there today? Never mind what employees are going to earn in the future, about what we've got today, and that actually manifests itself in terms of the solvency. So I'll use terms solvency, funding level, deficit. That's what that's related to. And when we come to assess your contribution rates as individual employers, we actually look at that for you based on your characteristics, and Jonathan will go through some of the detail about what actually affects that, and that drives your deficit contributions. But the other thing, of course, very important, is you do all have employees in the scheme, and they continue to accrue benefits. So we'll use terminology like future service. I'll use terminology around what's called primary rate, because that's the legislative definition of how we have to sort of build these things up. So some of these terms I'll use interchangeably, but effectively they are these two parts of the equation to come up with your contributions. So now this is a slide with lots of words on, and that was quite deliberate because it's meant to be structured in the way of the funding strategy, so to give you a flavour of all the building blocks that we have to actually look at before we drill down into what will determine your contribution rates. So when the fund circulates the slides to you, you'll have this as a bit of an aid memoir, and this, along with what's being consulted on the funding strategy statement, should give you a lot of detail. I admit we have to have that in, but what I want to do is give you the high level objectives and what we're actually considered. So I'll take them two at a time really. So the top two, this is about the sort of legal structure of the scheme, what we have to look at in terms of building up the funding plan. So on the top left hand side, we've sort of got the objectives of the fund. I talked about it a minute ago. You know, one of the primary objectives is to become 100% solvent, 100% solvency. And that's about doing that in a reasonable time frame. So thankfully, that doesn't mean if we identify there's a shortfall, we have to put all the money in today. It's about building up a plan to actually get there. And there's a number of things that actually feed into that. So as I said, it's about actually having sufficient assets to pay benefits, but it's quite categoric in the legislation that it's not about having all the money there today. And that's really what drives some of the decisions we make. So if you compare the LGPS to maybe a private sector scheme, it's a much longer time frame, which allows us to manage some of these issues in terms of what's your challenges, which is around affordability of the scheme. The one thing I always say, but I'm the actuary, so why wouldn't I say this, is about prudence. It's quite a sort of a motive issue. What we mean by that really is let's keep a little bit of fuel in the tank to make sure we can ride out some of the challenges that we might see in the future. So if you look at what we've done at the valuation, that was at 31 March 2016. There's been one or two things that have happened since then. Brexit, US elections, and just a general economic challenge, around China and that, which is also changing the outlook for investments, and therefore we need to think about that in the context of risk management. So prudence is about making sure we have enough in the tank to sort of ride out and keep that stability. So that's what I'll talk about, or we'll talk about when we're talking about assumptions. The top right-hand side, that's relatively new, this valuation. I think I touched on it last year, but now it's become more embedded. So again, this term solvency, this is in the legislation. So the Public Service Pension Schemes Act has come on stream, and actually that has specific definitions and conditions for all public service schemes. So LGPS, civil service, NHS, teachers. And really they're the definitions. So solvency is relatively obvious because we've used to it, we're used to funding level. So it's all about can reasonably met as they arise. So that comes back to my point, is that we don't have to have all the money in today, but we need a plan. Long-term cost efficiency is quite an interesting one. I think I'd drill that down to say that, well, when you're building up your contribution plan or your funding plan, is you can't knowingly pass cost onto future taxpayers. So in a very simple terms, that means, let's not pay any contributions now, let's not worry about it, but that actually will pass cost on to future taxpayers. So embedded in the legislation is some checks and balances around long-term cost efficiency. It does equally mean that you can't put too much of a burden on existing taxpayers. So that's about the balance. And last but not least, the desirability of stable primary rates, so the future service rate. What used to be the case is that the stability of contributions and solvency were about equal, but it's clear now under the new legislation, solvency trumps stability, and that's been a clear message from the Minister in terms of how you build up funding plans, which creates some challenge, but when we're building up the funding plan, one of the key things that we've got to consider is your challenges around affordability. So that's the sort of backdrop of how we have to build up the funding plan, both on a total fund basis and also on an individual employer basis. So moving on to the middle two, this is how we start to put the building blocks. There's a lot of debate out there about deficit. So when there is a deficit, we have to set a recovery plan to address that shortfall. And I think the issue here is a lot of what we'll talk about sort of at a headline level is the average for the fund as a whole. You all will need individual recovery plans based on your individual circumstances. And I think that's quite an important thing for you to realise, is that we look at your circumstances and that takes into account affordability, financial strength, and also your particular characteristics as an employer. So say, for example, if we knew that you were only going to be in the fund for 5 years, we wouldn't necessarily set a 25-year recovery period. So it's just practical things around how we build that up. I think on that point is one of the key things which we'll explore as we go through the presentation is that the intention at this valuation is to maintain the recovery plan. So if you think about it, we had an average recovery period last time for the funds as a whole of 22 years. Now we're bringing that down to 19, and that, now I know it sounds, well, it's obviously a reduction, but if you think about what we're doing, we're still trying to target the end point at the same time because we're 3 years on. So that's the intention in terms of keeping it ticking over. What we also need to consider, and Jonathan will cover this in much more detail as he goes through his part of the presentation, is the actuarial assumption. So this is the clever maths. You'll be glad to know that I'm not going to go into detail on how I model different parts of the assumptions, but I'm just going to sort of give you a headline. So one of the critical ones is around investment return. So you know I talked about the pension fund actually is there to pay benefits out. Well, there's only two ways you can actually finance that. You can get better investment returns, or you can pay more contributions in. It's quite as simple as that. And one of the key things that we have to consider is how much investment return we're going to earn in the future relative to inflation. So we'll call it a real rate of return. For those of you who are closer to the benefit structure, if you think about how pensions increase, so your liabilities, your benefit payments, it's in line with CPI, consumer prices inflation. So if you can get an investment return which beats that inflation, you're actually beating your liabilities, and the bigger that number, the actual cheaper the scheme, so the lower contributions you'll need to pay in. So that's actually a critical part of how the scheme operates. And Steve and the investment team actually concentrate and rightly put a lot of effort into maximising that, and we'll show you the impact of that on the valuation as we go through. The other thing that's important for us as actuaries, it might not be so interesting to you, is things around demographics. So life expectancy, number of ill healths, you know, how many people are married, how many people are in civil partnerships. All the demographic characteristics of the fund actually determine the cost. So if you think about it at a high level, the life expectancy in South Yorkshire is quite different than Essex or London. So we have to actually make those assumptions particular to the area, and that actually affects the cost envelope. So we do quite a lot of analysis there. And again, Jonathan will sort of take you through the quantification. But really what all this does is determine how quickly we need to fund that gap. So that's about the balance, so the pace of funding, you know, the recovery period, the assumptions. Are we going to assume a higher investment return in the future? I think one of the challenges, certainly, well, we're all seeing generally, is what's the impact of these things around Brexit on markets, on fiscal policy, what's the impact on a new president in the US, what's that going to do to trade agreements? All these sort of things will affect your expected investment performance. And one of the things I would say is a bit of a challenge at the moment, certainly for pension schemes, is it's possible we could be going, or more likely than it was, going into a period of relatively high inflation, but relatively low investment returns. So, you know, you talked about that gap, how big are your investment returns relative to inflation? Well, that's actually tightening, so that's been a challenge in terms of setting assumptions, but we are where I think I'm comfortable with where we are. And last but not least, just to build the picture, this is more around the operational and how we actually do it. So I talked about the valuation. Jonathan will talk a little bit more detail about how we build it up. But even though it's one valuation, actually it's probably, you could have, I can't even remember the number of employers actually, but it's probably about 350 mini valuations, and the number's getting bigger. So that's essentially what we have to do, which means we need to make sure you've got your right asset share. We look at your bespoke funding plan and your bespoke recovery strategy, and that's a key part of the consultation. So we'll go through that in a little bit more detail shortly. And then it has to be written down. I think one of the things that is very important for the FSS is around the policies. What do we do with new employers coming in? What do we do about employers going out? So that's termination policy. And also the arrangement we have within South Yorkshire around the insurance for ill health. How's that panned out? We have to document all those in terms of the strategy for you so people can pick that up and understand how we're operating the fund. I think one of the things that's becoming more important is around covenant and monitoring. Because one of the crucial things is risk management. And you as individual employers are responsible for your own liabilities, but if for whatever reason you couldn't pay those liabilities, then it might fall on everybody else. So making sure that we have the right funding plan in the context of financial strength, which is what I mean by covenant, is something that's becoming more important. And I think it's fair to say it's becoming more important on a national basis. So a lot of the guidance is sort of focusing on that. That sort of gives you an overview. So we'll now start sort of drilling down into what's changed. So the key thing here, if you think about, I like to use terminology like discount rate, effectively think of that as the expected investment return. And the crucial relationship there is that investment return versus inflation. And what our proposal is as part of the consultation is to maintain that for calculating the solvency or the funding level, effectively determining the deficit, but to reduce it by 0.25% for the future service rate. So that's your on cost, the percentage of pay element of your contribution rate. The other aspect which actually we've looked at again is around pay growth, because we're, well, you know, unless you tell me I'm wrong, is there's still not a great deal of expectation of pay growth within the sector because of the sort of fiscal policies put in place. So the intention there is actually to reflect that by a combination of short-term pay growth, so looking at 1% or 1.25% over the next few years just flat, and then also reducing the long-term pay growth by 0.25%. So that's a key change from last time, which combined probably reduces liabilities a little bit, depending on your profile. The other thing, and this may not affect all employers, in fact certainly doesn't affect all employers because it depends on your characteristics. We talked about demographics. One of the things that were introduced at the last valuation was the 50-50 scheme. So for those of you who don't know what that is, very briefly, is your members can choose to pay half contributions for effectively half benefits. What that does is actually mean the cost is broadly half, not quite half for you as employers because of some of the ancillary benefits. And the intention there that was meant to sort of make the scheme more attractive to certain cohorts, but also be cheaper. What I would say is that the take-up of the 50-50 scheme has been considerably lower than what anybody expected. I think that's fair to say, both in South Yorkshire and across the scheme. And I'll cover that in a little bit more detail later on when I talk about cost management and some of the national issues that I want to sort of address with you. But effectively what that means is we're going to have to remove the assumption because we just can't justify it because nobody's taking it up. So we'll look on the quantification of that when Jonathan takes you through some of the numbers. Talked about the updated demographics, life expectancy, ill health. Generally that's been positive, but we'll quantify that for the fund as a whole. Talked about the average recovery period, but I think the key thing here as part of the consultation is around affordability. What I would say is around affordability that as the pension fund actuary, what my primary concern is around the financial health of the pension fund. So I accept there might be challenges, but equally we've got to get that balance right. So what I would encourage there is as part of the consultation, you do feed that back. Last thing, it's the first valuation since we implemented the ill health insurance. So there's some interesting output from that, which Jonathan will cover when he talks about the quantification and the background. So that's it from me. That gives you the backdrop, and now Jonathan's going to tell you about what you really come to listen to, which is around the numbers.
Thanks, Paul, and good afternoon, everyone. So the next few slides will just go through a summary level of what's happened at the whole fund level, so across the whole fund, all employees within the fund, and what we've seen has come through in the results and the balance sheet for the whole fund. And then we'll touch upon a few things around what has happened to individual employers and what might affect your own positions and your own contribution outcomes going forwards. So on this slide here, we've summarised what we call intervaluation experience at the whole fund level. And what we mean by that is what's happened over the 3 years, 2013 to 2016, in terms of how that experience has panned out versus the assumptions we adopted at the last valuation. And we've summarised this in a few key areas here. And again, this is at a whole fund level, and each of your own experience will differ and will be quantified in the schedules that you will have received. So in terms of the membership profile, we've seen positive and sort of negative effects of membership profile changes coming through. The negative impact was really around the on-cost, the future service rate, or the FSR as we've denoted here. And what we've seen is that the overall age profile of the active membership at the whole fund level has increased since 2013. And typically, the older the pension scheme membership is, the more it costs to provide those care benefits going forward. So that has a negative impact on the contribution outcomes. On the converse, what we've seen on sort of the past service side of things and the deficit is that more members have left active service than we expected previously. So there'll be savings coming through there as members go to deferred or to pensioner status potentially. So membership profile changes both positive and negative. In terms of investment returns, what Paul's been referencing in his first section, what we assumed at the previous valuation, the fund has actually exceeded those assumptions in what's been returned over the previous 3 years, a total fund return of around 21%, and that's had a positive impact on the past service position, and as we'll see, will have reduced the deficit coming through at a whole fund level. And investment returns affect all employers in the same way. The next 3 items, typically what's good for a member is bad for the fund. So these 3 items here, CPI pension increases. At the previous valuation, we were assuming that the long-term level of CPI inflation, so that's the rate at which pensions get increased for deferred and for pensioner members, was 2.6% per annum. However, over the previous 3 years, as you'll all know, the actual pension increases granted have been a lot lower than that. And in fact, in 2016, were actually nil. So whilst bad for the pensioner members and the deferred members and that the benefits aren't going up that much, it's actually good for the fund because it's lower than what we thought might happen, and therefore there's a profit that comes through on the past service position. Pay increases, again, what's good for the member is bad for the fund. 2013, similar to what Paul's been talking around previously about short-term public sector pay restraint, within all the liabilities assessed for the employees within the fund, it was assumed that pay increases would be around 1% per annum over the 3 years. And what we've seen actually based on the analysis we've undertaken is that at a whole fund level, it's actually been higher than the 1% per annum. So good for members, but still in terms of the funding position, it's actually a sort of a strain coming through rather than a profit. In terms of pensioner deaths, again, an odd one this, it's good for the fund when pensioners die, but obviously bad for the pensioner. And what we've seen coming through in the last 3 years in the analysis we've undertaken is that there has actually been more deaths than expected over that period. So again, a profit coming through there. And similarly, as I've mentioned, some positive impact, although not probably as crucial as the ones above, for people retiring in ill health, lower than expected, more people leaving active service for deferred or pension status. So at a whole fund level, again, more green and red coming through, more positives there, but for each individual employer, the analysis will vary and the impact will vary coming through. So So just touching upon this slide here, some of the things Paul's mentioned previously. We've looked at the experience over the previous 3 years and what's happened versus expected, and as part of that assessment, we'll also look to see what might happen going forwards. Do our assumptions need to be refined in any way for that experience coming through? So we look across the South Yorkshire Fund and across all our local government funds that we advise. We collate data over a long period and sort of assess what trends have been in life expectancy, ill health, retirement, withdrawals, etc., the demographic assumptions, and then I compare that experience and the current trends against what was already built into the assumptions. So it tends on what's going to be impacting on the forward looking assumptions. So we've already touched upon some of these already. The life expectancy, more deaths than expected will bring down the deficit. And what we're seeing generally across the South Yorkshire Fund and across the local government is that the rate of improvement, people aren't necessarily dying off sooner currently, but in the future, we're expecting life expectancy to still to be a rate of improvement. So people are still living longer and longer. But what's happening is that rate of improvement has slowed down a little bit compared to what was previously expected. So life expectancies are still going up, but at a slower rate than previously. So by building in some of those changes to the assumptions, that has a positive impact on the overall results. In terms of ill health retirements, typically for the South Yorkshire Fund has good governance in place for ill health retirements. And so what we've seen from our analysis is that you're already on quite a low assumption for ill health compared to maybe some other local authority funds. And the analysis has shown us that there's still been a lower level of ill health than that previous assumption. So there's been a small impact coming through there for changing that assumption going forwards. For other funds, they were maybe not had the same levels of governance in place, and so they've had maybe a bigger reduction coming through for ill health retirements. For withdrawals, again, as I've mentioned, there's been more levers than we previously expected coming through over the previous 3 years, and I think there's a lot of restructuring going on in the local authority arena, as you know, and a lot of members moving away from active service to deferred status, which has a positive effect on the deficit position, but doesn't really have much impact on the on-cost, on the future service rate, given we're now in a care scheme and there's no longer a final salary benefits being accrued. 50-50, I know it's been touched upon in Paul's presentation and a bit in Gary's presentation earlier. We've had to remove that assumption that we had at 2013 for members to join the 50-50 section and accrue a lower level of benefits. So by removing that assumption, for those employees that had that assumption in their contribution rate, that pushes up straight away their on-cost, their future service rate. And we've also looked at the levels of commutation, so that's members exchanging their accrued pension for extra tax-free cash at retirement, and also the proportion of members when they die, when a partner or dependent pension comes into payment. And we've assessed those, and there's no real change to the results coming through from those assumptions. So how does that translate into the actual balance sheet for the whole fund? We'll come on to now on this slide. So here we've just summarised what the whole fund balance sheet was at 2013, at 31st of March. That showed assets of about 5 billion, liabilities, so the value of the benefits built up to the March 13 date of just under 7 billion, and a deficit, so that's the difference between the assets and the liabilities, of 1.7 billion. That translated to a funding level of 76%, which is just a ratio of the assets and liabilities. And the on-cost, so the average future service contributions that were paid by employers, was assessed to be 12.8% back in 2013. And just to note that for a lot of employees within the fund, and probably a lot of you guys in here today, the contributions you paid after the last valuation will probably have been based on an updated position at 31st of August, because I think there were quite significant changes in the markets between March and August at the last valuation, which reduced that deficit figure at a whole fund level. So a lot of contribution levels will be based on that lower deficit figure, as we've noted in the bullet points there. So taking all the analysis into account of what's happened since 2013, looking at the impact of the membership data that's been provided and the new assumptions coming through, we're now showing a balance sheet on the right-hand side there of assets just over 6.2 billion, liabilities are about 7.3 billion, which translates into a lower deficit figure. So good news there in terms of a deficit of about £1 billion coming through now, and an increased funding level of 86%. So an increase from both the March position at 2013 and also the August position, which was about 80% at 2013. What we have seen though is that on cost, that future service contribution rate has increased at a whole fund level, and we'll come on to some of the finer detail of why that's increased, but we've already mentioned the changes in assumptions, the 50-50, and they're the main drivers of that increase, and of course the ageing population. So in the next slide, we've just annotated here in numbers, sort of quantifying the things we've already talked about previously, why that deficit has changed. And I think for this valuation and for the ones I've been involved in, it's pleasing to see more green than red on the analysis coming through. As we've mentioned, there has been positive impacts and positive experience over the past 3 years, which has served to reduce that deficit coming through at March 2016. So just to pick out a couple here rather than going through them all in detail, because we've spoken about them already. Investment returns, good positive investment returns, greater than what we were expecting, has reduced that deficit coming through. The CPI pension increases lower than expected, again, reduces the overall liabilities. And although we've talked about sort of the 1% per annum built into the previous set of assumptions for short-term pay restraint, as Paul's touched upon, there's still that expectation that pay growth may be on the lower side on average over the next few years as well, especially in the public sector. So for the moment, at the whole fund level, we've built in another allowance for short-term pay restraint over the next 4 years at 1.25% per annum. And as I'll come on to in the next few slides, this is lower than our long-term assumption, which is about 3.5% per annum. So going forwards, if you as an organisation have higher pay growth than the 1.25 expected, your own analysis in 2019 will show a strain rather than a profit there, and that's something that's been built into all the results coming through to start with, but it's in the funding strategy as a consultation piece, and it's for you as an organisation to consider whether that going to be right for you going forward based on your own projections, and you can feed those thoughts back into the consultation with the fund. So we've looked at the deficit side, and this sort of compares that increase from the 12.8% for the average whole fund contribution rate to the high level of 14%. And again, just quantifies some of the points we've been making about what's affected the membership as a whole. So the removal of the 50-50 allowance, where we'd built in an assumption for 10% of the membership to join that fund, that's now being taken away, given the experience, so that automatically pushes up the cost. Now, for some employees in the room, there won't have been an allowance for 50-50 membership in your rates previously, so you won't have that immediate cost pressure coming through there. Membership profile, on average, the active membership has aged, so therefore that pushes up the cost. The change in the demographic assumptions, so that's the lower level of ill health retirement, the slightly lower levels of life expectancy coming through there, so that's a benefit, reduces the cost coming through. And as Paul's mentioned, we've slightly changed the discount rate for the future service calculation to a real return above CPI of 2.75% per annum. So again, that serves to actually push the costs up going forwards. And again, just to reiterate what we've been saying, this is at the whole fund level, and the impact on individual employers, as we'll come on to, will vary depending on your own profile, your own circumstances, and the experience over the previous 3 years. So just to build upon that now in terms of individual employer results, and I think for most of you in the room, or if not all of you in the room, if it's not yourselves, it'll be people in your organisation will have been sent out the preliminary results by Gary and his team over the past week or so in terms of what your contribution outcomes are looking like at the moment from April 2017 onwards, together with the funding strategy and associated documents just to support the information being provided. So 3 main elements really why results for each employer will differ. You're all in the same fund, and the active members are all accruing the same benefits, the pensions and receipt of benefits, but ultimately, as Paul's mentioned, it's like doing 350, 400 mini valuations and taking into account your own characteristics when trying to come up with the and calculate the contribution outcomes going forward. So the profile of your membership, which we've mentioned a few times, the gender profile, how many males, females within your organisation, and just in terms of the life expectancy, what we've seen in the analysis undertaken is that males are actually catching females up in terms of the life expectancy going forward. So good for us guys, we're catching you up, ladies. But what that means, again, if your profile over the previous 3 years has flipped from more males to females or vice versa, that can have an impact on the results coming through. Age profile we've mentioned, the older the membership, typically the higher the ongoing cost. And also in the care scheme, benefits are linked to state pension age. So with state pension age increasing, if you've got a lot of members who have a 65 state pension or a 66, their benefits will be more expensive to provide than if you've got a lot of members with a 67 or 68 state pension age, because the period to retirement from the current date will be longer for those other members. So profile of the membership is very key, in particular for the future service rate and the costs coming through for the on-cost. Membership experience, which we've touched upon in terms of the salary increases granted. If your organisation's granted pay awards greater than the 1% per annum over the previous 3 years, that will come through as a strain and on your analysis. If you've been there or thereabouts, then it'll be sort of a neutral going forwards. Staff turnover, number of members leaving the organisation, how many ill health retirements or people retiring on redundancy with early retirement costs, and to the extent to which those costs have been met already or being met by our employers. 50-50 proportion, again, I won't go into the detail there, but if you've had nobody take up the 50-50 rate, that will have come through in the membership experience. And as Paul's mentioned, this is the first valuation where we've analysed the impact of the ill health captive arrangement, and some employers in the room in here, depending on your type of organisation, will part of that captive arrangement. Others won't be necessary, so some of the larger sort of council type bodies. And just to briefly summarise for those who might not be aware of what the captive arrangement is, for a few valuations in terms of analysing results coming through, it was evident that for some employers, the smaller employers in particular, if they had an existence of an ill health retirement, a tier 1 retirement, which has the highest cost in terms of members being given access to their benefits early and having enhanced benefits, those costs had a massive impact on their own balance sheet, and a lot in terms of the contributions coming through had a big strain on affordability for those employers. So after the last valuation, we worked together with the fund to consider potential insurance arrangements for ill health retirements and seeking quotations from external providers, and also looking at ways maybe within the fund those benefits could be insured. And the captive arrangement works in a way that employers that are selected for that arrangement, typically the smaller type employers, part of their contributions will be sort of designated as being like a premium, as you would do for any other insurance arrangement, and we'll go into the captive pool, which is essentially a notional pool that we will monitor within the fund. And then any strain cost emerging from ill health retirements within the period, those costs will be met by the captive rather than landing solely on that one employer. So they have the protection there, paying a premium and having essentially in their balance sheet at the next valuation, there being no strain coming through. Now the captive will be monitored from valuation to valuation to make sure that premiums being paid in are suitable, and if there's not enough in the captive pot, then essentially there'll be a higher level of premium coming through, as with any other insurance arrangement, and going forward. So October 2014 was when the captive was implemented, and the analysis we've seen coming through so far is that there's been a lower level of retirements probably than expected, as I've mentioned. So for the moment, the captive has essentially a little surplus in there, which will be used to sort of ride out any future adverse ill health retirement experience. But acknowledging the fact that there's been lower levels of ill health retirement, the premium built into the contribution rates for those employers is coming down slightly. So a good thing, I think, in terms of the protection being afforded, and obviously we'll be monitoring that from valuation to valuation. Another factors, we've summarised there a few other things which will impact on employers to a different level. Starting funding level, were you fully funded at the previous valuation? Were you poorly funded at the previous valuation? Those who may be poorly funded at the previous valuation will have been paying in a larger element of deficit contributions over the previous 3 years to try and repair that deficit. So their funding level change from one to the other may be bigger than someone who was already well funded and didn't have to pay in those level of contributions. Prepayments of contributions, which I'll come on to a little bit more in a few slides, but essentially at the last valuation there's a facility for employers to pay their contributions early. So pay them either all up front at the beginning of the period or pay them in advance at the start of each year rather than gradually on a monthly basis over the year. So by paying in the contributions early, a discount can be granted for the early payment. But because of the excess returns over the previous 3 years, those who have paid in early have benefited from, say, the 20% return we've seen because the contributions have been in the fund for longer, generating those returns. Length of recovery period, again, the shorter a recovery period, you're targeting that fully funded position over a shorter time scale and then probably paying in more than an employer with the same deficit, but maybe who's paying in over 22 years rather than 10 years, say if you've got a shorter lifespan within the fund, as Paul's mentioned. And again, entry date for employers are typically, the previous valuation, we maybe had 200 employers within the fund. As Gary's mentioned, as Paul's mentioned, that's nearly double at the moment. We're thinking about 350 employees in at March 2016, and that's increased since then. So for new employees coming in during the last 3 years, it can be quite crucial really when they entered the fund, but in particular when the returns within the fund, because although it's been 20% over 3 years, it hasn't been, say, 7% per annum, as returns, as you know, can fluctuate over the period. So an employer coming in 2014-15 will have had a lot better return, say, over the period to the valuation date than an employer coming in 2015-16. So the funding level will reflect that in 2016. And if you've had 2 new employees within the period as an organisation or as an academy trust, say, which has had 2 new academies within the period, you may find the funding levels will differ for that reason. So just to show here what we mean by sort of the range of outcomes and sort of how each of those aspects can impact on all you guys as employers and all the main other employees within the fund. Funding levels were shown on the top right hand side, just at the range of funding levels. The red line there shows sort of the 86%, the average at the whole fund, but you can see there's a fairly even splattering of employers above and below the line. And as Paul mentioned the other day, I missed it, Paul's eagle eye spotted it. There's quite an even pattern to this chart, which I hadn't appreciated before. And obviously, we've done this by employer number within the fund, and then the fund operates in sort of, the districts are all grouped in the same sort of employer numbers, typically. So you do have sort of, it's split into four elements really. So you've got the Barnsley and the Doncaster, the Rotherham and the Sheffield towards the right. And you can see the profile of the employers there. Typically, the academies, the new employers are towards sort of the end of each section, and the more established employers who have been in typically the councils, the colleges, the universities, the community bodies who have been in the fund a very long time, are sort of towards the left of each section. So a wide range of outcomes coming through for the employers, which is documented there. And again, on the future service rate, so the top right-hand chart will dictate what contributions are paid in towards any deficit emerging or any surplus that's offset. And the bottom left-hand side, we've shown the range of future service contribution outcomes. So the on-cost, how that differs across all the employees within the fund. And again, a wide range of outcomes coming through there. Typically, the profile, as I said, will impact on the rates coming through. And also, whether your organisation is open to new members joining the fund or is closed to new members joining the fund. So we have a different assessment for those types of organisations. Typically an open employer will assume that the profile remains pretty stable from year on year. But for closed employers, nobody new is going to be coming in, so that average age profile is expected to increase as time goes on. And it's the assessment for those employees is typically an average of the future cost of benefit accrual, and is typically higher than an open employer, say. So those in the graphic there, probably 20%, above 20%, will typically be those employers that are closed to new members, and maybe sort of contractors who have closed admission agreements that they've set up with the councils. And just before we move on to sort of just commenting on some of the schedules that we've issued via the fund with the individual valuation results, we've inserted a slide here just about accounting figures and the valuation. And we had a query before we spoke today, Paul and I, from one of the employers, just querying their accounting position, that the latest set of accounting figures under FRS 101 or 102 or IS 19 showed a deficit, whereas their valuation schedule coming through actually showed a surplus position for that employer. And it's just a question, why are those different? And it's quite a common question that we do get through. And I think in particular, we've had a lot of questions after the latest set of accounting figures were issued for the academies, which have a year end of 31st of August. And as Paul's mentioned, since obviously 31st of March, a lot's happened in the markets. So the funding basis, what we classify as the funding basis, which we consult upon in the funding strategy statement, is a different exercise entirely to those that are done for accounting purposes. The accounting figures are solely required to for disclosure requirements. They're performed on an annual basis and then go into the employer's accounts. And the main differences between the two is the set of assumptions that the accounting figures and the funding figures are based upon. So the accounting figures are based on a prescribed set of assumptions. Typically, the discount rate, which is the main assumption, is linked to the yields available on corporate bonds, so for debt issued by companies. Whereas, as Paul's mentioned, for the funding assessment, we will look at the overall expected return outlook for the fund, taking into account what the fund invests in, so equities, bonds, gilts, property, so the wide range of different types of investments, and the discount rate will be set in line with that analysis. In terms of the valuation results then, from speaking to some people at lunchtime, some of you may not have seen sort of these types of schedules that are being issued, might have gone to different people in the organisation, but just to summarise for those who have seen them and just to give a picture for those who haven't, the results that are being issued along with the funding strategy for consultation have taken this format this year, which we've agreed with the fund. And typically, we'll be looking to show sort of the grey section, had we not done a valuation, what your contributions would have been over the next 3 years from 2017 onwards if we'd just carried forward the previous set of results coming through from the previous valuation. So just summarising what the current position was. On the right-hand side, we then show what's coming out for your organisation at March 2016 in terms of the balance sheet, the funding level, the deficit, what the on-cost, the target rate for the future services, and then how that then translates into contributions over the next 3 years, and splitting that out between the past and the future service. The contribution outcomes will have been set in terms of the funding strategy parameters that have been put forward this time around and are out for consultation. The bottom section, as I've mentioned, employers do have the option for prepaying contributions and receiving a saving essentially for paying those contributions early. So again, just to reiterate, there are 2 ways you could possibly look at this. And this option is only available for those with a deficit. For those in surplus, this option isn't available. So you can pay contributions early in April each year rather than on a monthly basis and receive sort of an annual saving on the contributions. Or depending on sort of cash reserves or your own sort of affordability, employers can look to pay that money into the fund 3 years worth of deficit contributions upfront in April 2017 and receive a bigger saving, reflecting the fact that there's 3 years worth of contributions there being paid in. So from the fund's perspective, it has the money in earlier, you can invest that money, but it also has treasury management issues to sort of put in place. So as part of the consultation, I think the fund will be looking for employers to sort of maybe comment whether that is something that they'll be interested in, so that the right processes can be put in place going forwards. And as I say, for those that did prepay previously, they did get the benefit over the previous 3 years of having the good returns. I mean, it's no means guaranteed, as Paul mentioned. Those returns will come through, but in which case employees would need to be aware the next valuation time there may be a strain coming through, but it is something that's becoming more and more popular with employers. Just before I move on that point, we would say from sort of an accounting perspective, from your own internal accounting, is to get auditors on board early on if that's something you are wanting to do. I think rather than make the prepayments and then come to do your accounts, and what we've seen is some auditors haven't been aware and start questioning what's going on, is have all auditors on board at the start of the process. And the second page of the slide, of the schedules that are being issued, again, just goes through really what we've shown at the whole fund level. Why has your results changed? And typically for those employers who were in the valuation last time around, we'll see all of this slide. Those who are new and weren't in the valuation in 2013, we don't have the same type of analysis coming through because we don't have the equivalent start position at March, so you'll typically just see the data slide. So a similar sort of bar chart there showing the main reasons, positive or negative, why your deficit or surplus position has changed. And the right-hand table showing why your future service rate has changed for the main reasons, the 50-50, the change in profile, and also the changes in the financial and the demographic assumptions. So just summarising for you so you can see why has my rate gone up or down, what are the main reasons for that. And again, the key membership experience over the previous 3 years. Have there been pensioner deaths more than that were expected? Have there been a higher or lower level of ill health retirements? And also, what the pay growth coming through the valuation has been in terms of the membership data that we've received as part of the valuation process. And I think building upon that, it really is sort of what Gary's been saying this morning about the monthly renewal system, which hopefully going forwards will lead to cleaner data. I think across the LGPS as a whole and sort of within the fund there has been issues in terms of having the renewal data issued and the correct pay figures coming through from employers. And in some funds we've seen completely random analysis coming through in terms of the pay recorded at 2013, the pay recorded at 2016, not necessarily yourselves, but they may have had, say, 40%, 50% coming through as implied by the data. Now, there may be some lucky people who have had 40 to 50%, but typically it points to sort of an issue with the data in terms of having to clarify that. So going forward, as Gary's touched upon this morning, having that monthly renewal in place, the extent to which those sort of inconsistencies will come through hopefully will be minimised and we'll get a clean set of data than previously have done maybe so to base the calculations on. And what we've shown there is just a weighted and an unweighted figure. So an unweighted figure is a straight ratio of those members who were in the last valuation and this valuation, what their pay growth's been in terms of the final salary, full-time pay. But typically what drives the analysis for yourselves is how that's weighted by the liability. If you've one member who's had a 20% pay increase but has only been in the fund 1 year, they're not going to have the same impact as, say, a member with a 20% pay increase who's been in the fund for 10 years, 15 years. So it's very much dependent on your own profile, what the impact coming through is. And then summary, we just summarise, finally in the bottom section, we've just summarised the data on which the valuations are based. We can't do any of our calculations if we don't have data provided by yourselves between the active members, deferred pensioners and the current pensioners. And so we've just summarised here so you can see how your profile has changed over the previous 3 years. And typically for smaller employers in particular, it's important to have the right data in to make sure you've got the right contributions coming through. So by summarising the data here, it gives you the opportunity to have a look at that and think, well, I've only got 2 actives. I didn't have 10 actives at the valuation date. Why is that coming through? Or my payroll's a lot different to that. Again, just to hopefully flag up any inconsistencies that, based upon the data we've been given, necessarily might need further investigation. And there are certain employers for the moment that we haven't provided results to the fund for that very reason, that the data that's come through is inconsistent against previous assessments and against what the fund holds. So we're just investigating further. So ultimately, you as employers will have to pay contributions in. So you want those contributions to be as accurate as possible based on your own profile. And as I say, for smaller employers, without that many members, a discrepancy of 1 or 2 can have quite a big impact going forwards. So just to finish off sort of my little section, quick slide here on just the timeline of where we are currently in the process and where we're going. As you guys know, it's an annual exercise that we have starting at March 16 with the effective date of the valuation. The process then becomes in terms of data, getting the data from yourselves to the fund, the fund then collating that data, resolving queries, providing the data to ourselves, then beginning the process of looking at funding considerations, assumptions, all the analysis we undertake, and then again back to the fund with in terms of initial results and having that dialogue about what the correct and justifiable assumptions will be. And we've had various meetings over the previous 3 months, also with Gary and the team and some of the district councils as well and some of the major employers in terms of then preparing the results for all employers within the fund and issuing the funding strategy for consultation, having the AGM today to sort of explain the key messages. So that's where we are now, and over the next month or so will be for you guys to consider your results as organisations, your own affordability. Is the data right for you having come through, and having that dialogue with the fund and raising any concerns going forwards. And ultimately with the overall sign-off of the valuation that Paul will have to make in terms of certifying those contributions being by the end of March, and any new contributions or increases in contributions or reductions will come through from April next year. And finally, just on my section, we've talked about it quite a lot, but just to reiterate again that the results are being issued now alongside the funding strategy statement, which pulls together all those building blocks Paul referred to on his earlier slide. And it's important as you're all stakeholders within the fund, you're all paying contributions within the fund, so it's important for you to have your say. And the consultation is designed to sort of invite those comments, and I think Gary would rather have employees engaging and being sort of aware of what's going on than employees just blindly accepting and then suddenly 2 years down the line raising a question, why am I paying this, what's happened there. So now's the time for sort of the next month or so to actually look at the results, look at the communications and feedback those comments for consideration. I think at the moment it's an early January deadline. So and following the January, then we'll start the process of looking to finalise all the outcomes, responding to any questions raised, and ultimately Paul going to sign off on the contributions. So key points really, as we've just summarised previously, the assumptions that were being used, any phasing plans or step-in plans in terms of contribution increases that are being sort of coming through in your own schedules. If you've got any particular concerns about affordability over the next 3 years, again, now's the time probably to start engaging with the fund rather than having those contributions certified and a problem coming up further down the line. And again, just to touch upon, I know there are some sort of academy trusts in here. Part of the consultation this time around will be for potentially inviting comment from academy trusts for paying an aggregate contribution. So rather than being 7 or 8 different certifications on Paul's certificate, there'll be one certification across the trust as a whole for the next 3 years. And again, speaking to somebody at lunch, I think that would be appreciated from their end in terms of managing contributions being paid into the academies within the trust. The consultation will go into more detail on that in terms of how it will be managed in terms of employers moving from trust to trust. But again, that's something that's new this time around for consideration. So before Paul covers some of the current issues, I think we'll invite questions at this point in time. I think at the moment we'll invite any general questions about the process as a whole and any general comments coming through. Paul and I and Kieran, our colleague over there, will be around after we've concluded the session if there's any particular questions about your own results in terms of we can sit down and try and answer those at the time. So if anybody's got any general questions now, raise your hand. Okay.
Or not.
They're all happy. So
I can sign all the contributions off. No problem. Are you good to go then? Is that okay? Well, I'll try and rattle this through. So if, as Jonathan said, if there is anybody who wants to come to talk to us one-to-one, then we'll be around. to talk about your own individual circumstances, or if you were too shy to ask a question in the open forum, then please do come up to us afterwards. We've sort of talked about the valuation, and obviously it's a huge exercise around the governance of the South Yorkshire Pension Fund, making sure that we are making plans to keep everything on track. There is quite a backdrop on a national basis around higher scrutiny. I touched on some of it earlier on when I started the presentation off. I mentioned these things around solvency, long-term cost efficiency. That's actually getting more and more sort of impetus at a national basis. So there's in particular certain national bodies, the Scheme Advisory Board, the DCLG, Treasury are becoming very much involved in these schemes about how they're being operated. One of the crucial things, as you've probably seen in the press and seen in communications, is around the pooling of assets. You'll be glad I'm not going to go into that today, but there are a number of areas that I just wanted to touch on very briefly. Again, we set this up, lots of words, hopefully you'll listen to what I say as opposed to just read it. This is just making sure when you get the slides through, you've got the detail. So one of the things that has been around actually for a little while is a cost management. Sounds a very grandiose term, I suppose it is in a way. Think of this as almost nothing to do with the South Yorkshire Fund on its own. What cost management is about the LGPS as a whole. So going back to when the new scheme was designed, so the new scheme from 1st of April 2014, it became a CARE scheme. Retirement age was linked to state pension age. There was a cost envelope that was looked at by the government. So in overall, how much is this going to actually cost us? But on the back of that, actually, there was a cost management structure put in place to keep track on those costs. So effectively, if the costs get higher, then there may very well be a change in the scheme to sort of bring it back down to a reasonable level for employers. I think what's fair to say is this is definitely going to affect this valuation and probably would kick in potentially from 1st of April 2019 at the earliest. So may very well affect the next valuation, so contribution rates from 2020. But it is still quite a hot topic now because it's actually being assessed at the moment. So Gary will be delighted to know that I think if you put in all the protections, we've got about 5 schemes, I would say, within the LGPS, 5 different benefit structures. Or we might have 6 soon, we never know. And what this is meant to do is actually look at predominantly demographic factors, some of the things that we've actually talked about. This is not about investment return or how your actuary assesses liabilities. It's about life expectancy, ill health, 50-50, what's really driving the cost. And really it's about the balance between employers and members. So if cost goes up, they have to be rebalanced. Because at the moment, if cost goes up, it's the employers that pick up the tab. So all this is about is maybe readdressing that balance, and that might manifest itself in a change in benefits or an increase in member rates. Could work the other way, but there's certain things that are actually meaning that the heat is on for the scheme. Just to confuse everybody, there's actually 2 processes here for the LGPS. All the other public sector schemes only have 1 process, and that's run by HMT or the Treasury. There's also the Scheme Advisory Board sort of measurement, so there's 2 parallel things here, and I'll try and summarise it as simply as possible. If within the cost envelope under the Treasury basis, the costs go up by more than 2% of pay, so we've talked about contribution rates, then something has to happen. Treasury probably aren't too bothered if it stays within that 2%. You as employers may very well be very bothered about that, but that's basically what it is. Where for the Scheme Advisory Board process, that actually looks at different sort of quantum. So it'll look at 0 to 1%, then 1 to 2%. If it goes over 2%, then the Treasury kicks in. I would describe it as 0 to 1%. They might do something, probably won't. 1 to 2%, there's a good chance they'll do something in terms of changing the scheme. And then, of course, over a 2% increase in cost, they rebalance it through benefits or member contributions. I think there's a lot of debate at the moment because as part of the cost envelope, we talked about the 50-50 scheme. It wasn't just us who put something in the valuation, it was the Government Actuaries Department who were responsible for looking at the costings. So the 10% take-up is in there, and what we've seen across the LGPS is probably 0.1% take-up, if that. So what that has meant is that it's increased the cost of the scheme by about 0.7%. Sorry, actually, no, I've got that the wrong way around, 0.9%. There's also another couple of things which is actually increasing the cost. It's about the transfer club. That's about transfers between public sector schemes and also the revaluation of benefits. That's added another 0.7% on. So at the moment, the knowns, the current knowns, are actually saying the cost of the scheme has gone up. However, the unknowns, because the analysis hasn't been done across the LGPS as a whole, not just South Yorkshire, every fund, is around things around pay growth, longevity, you know, the things that we've spoken about, which actually might be a positive and push it the other way. I think if I was a betting man, and you'll be glad I don't bet too much as the actuary to the fund, I would say there's probably going to be a change in the scheme. That would be my gut feel. So there's going to be something for you as employers to communicate to your members as well as the fund. We've got a few years to see how it pans out, but that would be my bet. And at the moment, if the trends carry on as they are, I would say it's probably going to be a rebalancing of cost to the members from the employers. But we will wait and see. The other thing about national scrutiny is there's a lot of discussion about benchmarking. We talked about the pooling of assets. That's about helping to reduce costs, helping more efficient investments. But actually what we're also being scrutinised for is around how funds are being run in terms of the financial management. So this is the Scheme Advisory Board way of looking at these things. And what we've got to do is an assessment around KPIs, key performance indicators. That's done on a benchmarking basis. You know, we've talked about assumptions. So assuming your discount rate currently is 3% above inflation, which is a key driver. So things measured there, and you can see there's only 18 of them that we have to consider, is for funds to self-assess how their actual funding plans, what they're looking at, you know, how the funding levels change, what the contributions are doing, what your deficit recovery is, and also how that fits together with the investment strategy. And it's essentially trying to get a picture of the funds on a side-by-side basis. There's a lot of debate about this, you know, because as you put league tables, if you're higher, that's great. If you're lower, perhaps not so great to the outside world. But the intention is to actually improve governance. The Scheme Advisory Board themselves don't have any power necessarily to do anything about it, but actually there is another tenet of this which is embedded in legislation, which is around what's called the Section 13 valuation. Section 13, you may hear it, you may have seen it in various discussions of previous sessions. Section 13 is just a particular section of the Public Service Pension Schemes Act, which is, gives the power for the government to intervene on the schemes. This is not just the LGPS, this is all schemes. And what essentially it does is to try and tease out different measurements to see whether the schemes have a robust funding plan in place and a robust risk management plan. And so it's all measured, and I'm not going to test you on all these statistics, I'll sort of drill it down, but this, what it was happened, it was done what's called a dry run based on the 2013 valuation, and I've just summarised the South Yorkshire outcome. So Jonathan talked about last valuation, we had a funding level of 76%. Actually on the standardised basis, so the comparator basis, it was 94%. We don't have the full details of the Section 13 basis for this set of valuations yet. They're expected to be out in, I think, January or February, and then there's going to be a process of consolidation across funds. If you looked at the 31 March 2016 funding level, assuming the same basis, it'd be 98%, so close to full funding, which is good, because what that means is positive indications. So you can see there, it's probably not as dark green as it shows in the report, but you see the long-term cost efficiency measures and the solvency measures. You want to be green. It's actually a positive thing for the fund that it is green, and I'm expecting all our measures to be green. It isn't actually the case for all funds, I have to say. And there's a red, amber, green rating, and effectively if you get too many reds or too many ambers, then the government effectively have the power to intervene. So we get put on the naughty step, as I like to call it, and effectively rip up your funding plan and start again. So we don't want to be there, and I don't think we will be, but it's just giving you an idea of a backdrop that we have not had this scrutiny before, but of course all these things that are being measured we've always taken into account, and it's about good governance, but it's just something to bear in mind. Does it improve governance? My professional opinion, sort of. I don't think it should be a driver of decisions. We shouldn't be making funding decisions on a local basis to actually just tick the boxes on that. What we've got to do is make funding decisions which fit the local characteristics and local profiles. Does it say if the scheme is well run? Yes, possibly, but there's lots of other things, and we've touched on some of them today, is about how well the scheme is run. And it is a fairly blunt instrument, so in isolation probably not, but it is one part of an overall governance check, which certainly the Pensions Committee and also the local pensions board will be interested. Does it support risk management? No, probably not. I think my concern is if lots of people look at this as the benchmark, it could encourage a race to the bottom in terms of funding. I've seen this in the private sector. I know I don't look it, but I've been around for a few years, and I've gone through a number of these sorts of things for the private sector. One of them was called the minimum funding requirement, which is sort of what this is, but not quite the same. And, well, that didn't improve anything, in fact. And that came in after, Robert Maxwell. So I just think my view is, yes, it's a good thing, and we should look at it, but we've just got to be careful how it's interpreted and used, I would say. So just going on to some current issues. Public sector exit payments. Very exciting topic. What I would say is that we've probably had 3 goes at this over a period of time. The idea is effectively when you're in the public sector, and this covers not just local authorities, not just other public bodies who participate in the South Yorkshire Fund, but it's civil service, it's NHS, there's lots of different things here, is about essentially fairness across the sector, modernising and flexibility for the employees. I think principally it's actually to try and get a handle and reduce these costs. And if you look at the consultations, it does strapliner and say, public sector terms on exit, so redundancy, are more generous than private sector. So if you think about the LGPS, redundancy lump sum, negotiated by the employer, to 2 years pay, I'm generalising here, but I think the key thing for the pension fund is you get access to immediate retirement benefits if you're over 55, which, as some of you may well know, requires additional contributions on top of your contribution rate. And one of the things there that has been drawn out for the LGPS as part of this is that can lead to significant costs and one-off payments. And what the intention is to consider whether that should be limited. So if we look at what's already agreed, so left-hand side, we've got these 2 things here are embedded in primary legislation, but the secondary legislation isn't there to enact them yet, and I think it's still being discussed, and I'm aware that there's a lot of debate going on in with government about how this actually should pan out for the sector. So I'm showing you all this today, but it wouldn't surprise me if I came here or Gary sent you a note out when this has all changed. So just sort of bear that in mind in terms of actually interpreting it. But this is basically where we are. So there's a 95,000 cap on total exit payments. So that includes your pension costs. And then there's also a clawback from highly paid rejoiners. So if somebody's left the sector on redundancy and then came back, then actually you ask for money back from the individual. What that actually could in fact do, because it includes pension costs, is the person might have actually gone out with a lump sum, but because pension costs are in it, they could be asked for more than that back. So for individuals, actually, it's quite an interesting dynamic. But the latest consultation is around putting a cap in on salaries. So the maximum pay you can use on exit payments is capping at 80,000, maximum payment 3 weeks, and so on. I think for the pension fund, I think it's around limiting the early access to pensions. So one of the things that they're thinking of here is actually increasing the age 55. So in general legislation, there's an expectation that the earliest age you can access your benefits will go up to 57. I think it's in 2028, which I just miss. So the issue is, so there's a thought about actually bringing that forward. So for the sector, actually pushing that out, so that'll limit costs, cap the benefits available, remove enhancements altogether. So basically not having a situation where a member is automatically eligible for unreduced benefits if they go on redundancy. What I would say is actually this is all public sector, but each part, so civil service, NHS, have got to agree this separately. And I think the intention was to try and get a way forward by the end of the year. Well, good luck with that one. I think it's going to be difficult. I think there's a number of hoops to sort of jump through, and in particular from the pension fund's perspective, I'm hoping that they'll actually take into account the administrative difficulty for the pension fund and also for the employers of doing something complicated. If I was a betting man, and I keep talking about I'm being a betting man, I'm not really, but if I was, my feeling is that they will remove access on an unreduced basis. That would be my gut feel for what might come out of this, because that might be the simplest option. Moving on, new fair deal. This is something that's currently governed in different ways for you as employers. So most LGPS outsourcings are governed by best value authorities, and that's for councils and a number of others, fire, police, depending on actually what type of body you are. But also some are still covered separately by the fair deal guidance, so that's the academies and schools. The current key feature of where we are today is that at the moment, the best value directive says the contractor, if it's outsourced, can choose to go or maintain participation as an admitted body in the LGPS or offer a broadly comparable scheme. Unless Gary is going to say it's something I'm not aware of, I think most actually go for the admitted body these days. I would say there's very few that offer the broadly comparable route, and I'd be interested in your views on that. In my experience, that used to be quite prevalent. So that's where we are at the moment. The new fair deal, the proposed changes, now you can see there from the left-hand side, is this came in from most government departments quite a number of years ago, so October 2013. And I say the DCLG have been currently consulting on implementing new fair deal for the LGPS to replace the best value direction for quite a while now. As you know from our discussions, they've had other challenges, so this has not been top priority. And I think it was at a sort of recent conference, I think they've got half a person looking at this. So it's actually quite resource constrained. So whilst it's a very important thing for the sector, I suspect there's still some way to go before this is embedded, but there is consultation around regulations which are out there and people have responded to, which I'll touch on in a bit more detail. I think it possibly will come in next year. My gut feel is probably from 1st of April if they can manage to lay the regulations, but as I said, is that might not be the case. So the key features, no more broad comparability schemes, so the only choice will be to stay in the LGPS. There are some exceptions to that in terms of what you call second generation transfer. So if there's still if somebody's in a broadly comparable scheme now, it may be they can stay in that broadly comparable scheme and others, but over time, generally, as per other public sector schemes, all the membership's going to stay within the scheme. But what it does do is create a protected employee status, and I'll come on to what that means on the next slide. One thing I would say, which they've slipped in to the regulations, is around exit payments at the end of the contract. The new regulations, or the proposed regulations, actually says if there's a surplus, so if assets are greater than liabilities at the end of the contract and a contractor exits, then you can now pay that surplus back to the contractor. Now, that might sound fairly obvious, but it does have knock-on effects to how you structure deals, how you build up your commercial terms, and also how the fund's policies actually develop in that context. So if it goes ahead as it's written, then it's just something you as employers, who if you outsource staff, and also the fund just need to make sure that's aligned, but we'll come back once that's actually done. So I mentioned it. One of the things it does do now is the best value direction actually puts the onus on the outsourcing authority to make sure pensions is protected. What the new regulations and new fair deal is actually create a category of person called a protected employee. So the protection around pensions follows that individual. So say, for example, they're outsourced once and then outsourced again, their protected status will actually follow them around, different contractors, if they're working on the same contract. Now, that's unusual for this sector, and I've not seen it since back in the day when we were doing this in the sort of late 90s. I have seen this in the context of the nuclear sector and the electricity sector, effective protected status. So whilst in theory it doesn't really change the goalpost too much, it does have implications on the administration and making sure both the fund and employers can track these employees as they go through the sort of life cycle. Doesn't apply to all employers in the LGPS, the new fair deal. So you can see on the right hand side, it doesn't apply to further and higher education employers and police and crime commissioners, but it will do to councils and most others. You can see on the bottom, I've touched on it already, there has been a period of consultation on this and a hell of a lot of discussion. I think it will be brought to the conclusion next year, but as I say, as the DCLG are quite resource constrained at the moment, so we'll just have to keep a watching brief on that. And I think that's it. So I hope you found that useful. It was a bit different from the valuation, but I do think these issues are actually going to be quite important for the fund and employers going forward, so it is important that you're aware of them and can react accordingly. So we're very happy to take any questions now, or obviously talk to you on a one-to-one basis. Hello.
This may be a very stupid question.
There's no stupid questions.
It probably is. You'll have to forgive me because I'm not a finance person, I'm a personnel manager.
Okay.
So with all the careful things you've told us about planning the future and things for the scheme and things, it might be a really difficult question to answer, but can you tell me where the deficit came from in the first place?
I can. It may very well be particular to your circumstances. So essentially the deficit comes from the history of the employer. So let's take an example where an employer starts off and they pay contributions in which equal the liabilities. So in theory, there's no deficit. But what we find is that over periods of time, deficit or surplus can arise for different reasons. So we talked about one of the critical things at this valuation is around the investment performance. If investment performance, as it has been negative, or there's been a less positive outcome than what we've seen at this valuation, that can create a deficit and can sometimes take a while to pay that back. And then, on the other hand, there is other things which actually on the financial side which can increase deficit. So at this valuation we've talked about inflation. Inflation affects your benefits. If inflation's high, increases your liabilities, so that can create deficit. And then we drill down into other things around your membership experience. So if you've had lots of ill health retirements, that tends to create a deficit, and vice versa. So I could probably go through a list of about 25 different things which could lead to the deficit, and our part of the valuation is us adding up those components and actually coming up with that figure. Does that answer your question?
Well, it does, but I still feel aggrieved because we are an academy and we became an academy 3 years ago, and we've inherited this deficit from our LA, which just seems really wrong.
Well, I take your point. Can I just answer that specific question? You as an academy were previous an LEA school, which were paying part of the deficit. Now, in terms of the policy, the way the DFE have set that policy up is you as an academy who only take current employees from the school, not the deferreds and pensioner liabilities, is that the intention is effectively you take that deficit with you. And all we're doing as the pension fund is reflecting that guidance from the DFE. So not that I'm putting my hands up and saying, don't blame me, but I am really. Is that it? So we are constrained to some degree by what actually the policy intention is. So, you know, we have to reflect that when we start you off, I'm afraid. But I take your point.
Just a quick question from me then, Paul, if you haven't got Brother Mike. It's just on the very last point, actually. Thanks.
The bit about the new fair deal not applying to further and higher education employers and the PCC, the Police and Crime Commissioner. There's not an immediate obvious rationale to me why that should be the case. Is there one that you're aware of?
I think fundamentally, certainly further and higher education, the way the sector's changed, it's become sort of more private sector focused, I would say, in terms of how it's funded. So I think it's partly a consequence of that. The Police and Crime Commissioners, I'm afraid your guess is as good as mine. So I don't know. That's just the way actually it's being constructed. The Police and Crime Commissioner isn't here, maybe they can answer. But I'm not sure on that one, but I've seen certainly in the education sector, it's almost treating it as a move away from public sector, and fair deals meant to be public sector.
Thank you very much, Paul.
Okay, I got off lightly there.
Okay, thank you. Right, Steve wants to just say a few words.
Well, I think that's bringing things more or less to a close, I think. So I just wanted to say some very brief closing remarks, really, to thank a few people. Firstly, you for coming and listening and participating and giving us quite a bit of feedback to take away, and for your demonstrable support, really, to Gary for his strategy for the way forward, which is particularly important. I also want to thank Joe and the team for making all the arrangements and the support arrangements for today, because it's been very well done, very nice lunch. Thank you very much for that. I have a couple of ambitions for the future. One is to find a really complicated question. You might be able to help me here, that I can ask Gary that he doesn't know the answer to. And Secondly, it's for Ian, really, that I expect by this time next year, using his left hand, he'll be fully ambidextrous. So we'll get twice as much work out of him from then on. So there is some gain from the pain, I think, here. But he has come along today, and he is in pain, and he's done all that today with his arm and this thing. That's tremendous. I'd like to say that, I mean, I've been here since July, and actually I'm realising that with Paul and Jonathan in particular, I've spent probably as much time with them as anybody else in that short period of time, this being a valuation year. So really a lot of thanks to Merce's, who we've got a long relationship with here, South Yorkshire, to Paul and Jonathan and Liam for all of the contribution today. And in fact, a lot of that last stuff really for me was a reminder of some things I should have known more detail about, particularly about all that New Deal stuff, Fair Deal stuff. And I think just sort of last closing remarks, I mean, I hope you all agree with us that the LGPS is a world-class pension scheme, given tremendous benefits to staff. And here, certainly the team here in South Yorkshire pension team, think it's a really important thing, well worth working for, very committed to working for it, and really need your help and cooperation, particularly moving forward, so that we can make sure we give, you know, a great service for all who sail in the LGPS here locally for the future. So thanks very much for coming today.
Okay, thank you very much. That's the end of the meeting. You can now go home.